Management's intent dictates how a commercial skyscraper appears on a balance sheet, regardless of the physical materials used to construct it. Under International Accounting Standard 40, investment property is defined by a narrow set of criteria. It consists of land, buildings, or parts of buildings held to earn rental income, capital appreciation, or both. Every property enters a decision tree based on economic purpose. Operational and administrative buildings fall into IAS 16 as PPE. Assets for ordinary sale route to IAS 2 as inventory. Only assets exclusively for rental or capital appreciation enter the IAS 40 investment property box. This initial classification determines the specific accounting standard and measurement rules the asset will follow for the rest of its life cycle. However, professional judgment is required when a property is acquired with an undetermined purpose, such as vacant land bought without a finalized development plan. The standard manages this ambiguity through a default rule. If the purpose is undetermined, the asset is classified as investment property under IAS 40. The boundaries of classification also depend on whether the entity retains the risks and rewards of ownership through its lease structures. Consider a property given out to a tenant under a finance lease. In a finance lease, the physical asset is derecognized from the lessor's books entirely. Without a recognized asset, the question of IAS 40 classification becomes moot. For those properties that remain on the balance sheet, initial recognition remains consistent. The property is recorded at cost when future economic benefits are probable, and those costs can be measured reliably. While initial recognition is harmonized, once a property is locked into IAS 40, its future measurement path moves in a different direction from standard PPE. Subsequent to that initial entry, an entity must make a formal accounting policy choice. Investment properties must be measured using either the cost model or the fair value model. The mechanics of the cost model are identical to those used for standard equipment. The asset is carried at its original cost minus any accumulated depreciation. The true complexity of IAS 40 emerges when an entity moves away from the cost model to apply fair value. Comparing the revaluation model of PPE with the fair value model of investment property reveals several structural divergences. The first row illustrates the scope of application for these models. Under IAS 16, a company can select different measurement models for different classes of assets, such as revaluing buildings while keeping machinery at cost. IAS 40 requires uniformity across the entire category. If the fair value model is chosen, it must be applied to every investment property owned. The second row tracks the required frequency of these valuations. Property, plant, and equipment can be revalued infrequently, often every 3 to 5 years, provided the carrying amount doesn't differ materially from the market value. IAS 40 mandates annual fair value assessments at every reporting date, regardless of how much the market has moved. This makes the fair value model an all-or-nothing annual commitment, carrying a much higher administrative burden than standard revaluation. Row 3 of the matrix highlights how standards route valuation gains. For property, plant, and equipment, gains are routed through other comprehensive income into a revaluation reserve. For investment property, those same gains bypass OCI, recognized directly in profit and loss. Consequently, investment properties have no revaluation reserve. Market volatility shows up immediately in the company's reported earnings. Row 4 tracks the final divergence, the treatment of depreciation. Revalued assets under IAS 16 continue to be depreciated over their remaining useful lives. Under the IAS 40 fair value model, depreciation stops entirely. The property's value is updated to its market rate each year. There is an important exception regarding land. Because land has an indefinite life, it is never depreciated, regardless of which standard or measurement model is applied. These mechanics illustrate exactly why initial asset classification matters. Treating an investment property like standard PPE leads to incorrect depreciation entries and the misrouting of gains away from the P&L. Assets occasionally transition between standards through a change in use transfer. However, a change in management's intent is not enough to trigger a reclassification. The framework requires physical, observable evidence that the building's economic function has changed. If a company moves its own operations into a building it previously rented out, owner occupation begins, moving the asset into PPE. Similarly, an entity might issue a notice to vacate to a tenant to begin redevelopment for sale, providing the evidence needed to move the asset out of IAS 40. The exact date this physical evidence appears serves as the boundary line for all future accounting entries. Revaluing an asset during a change in use requires following a specific chronological rule. Up to the exact date of transfer, the asset follows its old classification rules. Imagine a property moving from an investment property into owner-occupied PPE. On the transfer date, the asset updates to current fair value. Final gains or losses are recognized in the P&L, consistent with IAS 40 rules. Once the asset crosses that boundary, the new classification takes over. This fair value becomes the deemed cost, acting as the foundational cost for its future as property, plant, and equipment. Finally, IAS 40 includes a mandatory disclosure rule. Even if an entity chooses the cost model for its investment properties, it must still calculate and disclose the fair value of those properties in the notes to the financial statements. These rigid protocols for intent, measurement, and transfers are not arbitrary. They ensure that the economic reality of a building is always reflected in the financial data reported to the market.